Welcome to Thoughts on the Market. I'm Jay Bacow, co-head of Securitized Products Research at Morgan Stanley.
And I'm Jim Egan, the other co-head of Securitized Products Research at Morgan Stanley.
Today, we're here to talk about why mortgages offer value after Jackson Hole. It's Tuesday, September 2nd at 2 p.m. in New York.
So, Jay, let's start with the big picture. After Jackson Hole, the Fed seems like it's leaning towards cutting rates in a steady, almost programmatic fashion. And in prior episodes of Thoughts on the Market, you've heard different strategists at Morgan Stanley talk about the potential implications there. But for mortgages, what does this mean?
Well, it takes a lot of the uncertainty out of the market, and that's a big deal. One of the worst case scenario for agency mortgages that the investors are buying, not mortgages that homeowners have, would have been the Fed staying on hold for much longer than expected. With that risk receding, the backdrop for investors owning agency mortgages feels a lot more supportive. And when we look at high quality assets, we think mortgages look like the cheapest option. Jim, you mentioned some of the previous strategists that come on Thoughts on the Market. Our global head of corporate credit strategy, Andrew Sheets, had highlighted recently how credit spreads are trading at basically the tights of the past 20 years. Mortgages are basically at the average level of the past 20 years. Seems attractive to us.
And that relative value really does matter. Investors are looking for places to earn yield without taking on too much credit risk. Mortgages, particularly agency mortgages with government guarantee there, they offer that balance.
Right. And it's not just that balance, but when we think about what goes into the asset pricing, the supply and demand picture makes a big difference. And that we think is changing. One of the reasons that mortgages have underperformed corporate credit is that when you look at the composition of the buyers, the two largest holders of mortgages are the Fed and domestic banks. The Fed's obviously going to continue to run their portfolio down, but domestic banks have also been on the sidelines. And that's meant that money managers, and to a lesser extent overseas, have had to be the largest buyers. But we think that could change.
Right. With more clarity on Fed policy, banks in particular may get more comfortable adding mortgages to their balance sheets, though the exact timing depends on regulatory developments. REITs might also find this more compelling.
Right. If the Fed's cutting rates, the front end is going to be lower, and that's going to mean that the incentive to move out of cash should be higher, and that's going to help both banks and likely REITs. But then there's also the supply side. Net issuance of conventional mortgages has been negative this year. That's obviously good. And some of the other technicals are improving as well. Rolls are trading better, and all of this just contributes to a healthier landscape.
Right. And another thing that we've talked about when discussing mortgage valuations is the importance of volatility. If you're buying mortgages, you're inherently short rate volatility, and volatility has come down meaningfully since last year, even if it's still above pre-COVID norms. Lower volatility, supportive for mortgage valuations, especially when paired with a Fed that's cutting rates steadily. Though, Jay, some of that already in the price?
Yeah, look. We didn't say mortgages were cheap. We just said mortgages are trading at the long-term averages, but in an environment where stocks are near the all-time high and credit's near the tights of the past 20 years, we do see that value. And the Fed cutting rates, as we said, should incentivize investors to move out of cash and into securities. Now, there are risks. When valuations on other asset classes are as tight or as high as they are, you could see risk assets broadly underperform, and mortgages are a risk asset. So if credit widens, mortgages would not be immune.
And timing is important here too, right? Especially we think about banks coming back. If they wait for full clarity on Basel III proposals, that could be delayed. On top of that, there's prepayment risk.
Yeah, if rates rally, then speeds could pick up and investors are going to demand more compensation. But summing it up, mortgages look wide to alternative asset classes. The demand picture we think is going to improve, and more clarity around the Fed's path is going to be supportive as well. All of that, we think, makes us feel confident this is an environment that mortgages should do well. It's not about a snap tighter and spread. It's more about getting paid carry in an environment where spreads can grind in over time. But Jim, we like mortgages. It's been a pleasure talking to you.
Pleasure talking to you too, Jay. And to all of you regularly hearing us out, thank you for listening to another episode of Thoughts on the Market. Please leave a review or a like wherever you get this podcast, and share Thoughts on the Market with a friend or colleague today.
Go smash that subscribe button.
The preceding content is informational only and based on information available when created. It is not an offer or solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you.